Now, we also have costs of issuing common stock. There's underwriting cost, accounting, legal, taxes, and this is reported as a reduction in the amounts of paid in capital. Okay? We also have a thing called reacquisition of stock. Companies sometimes purchase their stock back. Sometimes they believe the stock is cheap, so they'll buy it back, and then they can own it, so they can resell it later or increase their stock price. So that's called the purchase of treasury stock. So, for example, when you have a purchase of treasury stock, you used your cash to buy the stock. So what happens is, say you want to buy Pacific reacquires, say it acquires 10,000 of its own shares at 11. Okay, so they were issued at 10, now it's acquiring them at 11. So it's spending 110,000 of cash. So it's less cash, and you debit the treasury stock account, which reduces equity. So your picture before was, we saw what the equity was before. Now your equity went down by 110,000. Okay? Now, depending on what the cost was, you may record a profit, sort of, on the sale or of the treasury stock. So, for example, if you have Pacific acquiring 10,000 treasury shares at $11 per share, and now sell 1,000 shares at 15 per share, Pacific is going to record the entry as follows. So you have your cash, right? You have your cash, 15,000, and you have treasury stock, right? So we have 1,000 at $15. So you have your treasury stock at, you credited 11 and paid in capital from treasury stock at 4. Okay, so we have, so it acquired at 11, now sells at 15. So there is a certain additional capital that it made, and that additional capital goes to paid in capital from treasury stock, is a credit. Now Pacific sells an additional 1,000 treasury shares on March 21st at $8 per share, and it records the sale as follows. So you have your cash, right? So there's cash, and the debit goes now to 3,000 because you're reducing. You sold 11,000, but now you only got $8,000 in cash, so the difference goes to paid in capital from treasury stock. So paid in capital from treasury stock is like your profit or loss account that stores the difference between your cost and what is now the sale price. Okay? Now, I also made an example here in my file of what happens for treasury stock, just really simple. What happens when you have a treasury stock buyback. On my side, I have a treasury stock here. It's actually negative. Is negative. What it does is it creates a negative contra equity account here, and it reduces my cash by 100,000. So I went from 300,000 in cash here and 300,000 in equity to 200,000 in cash and 200,000 in equity and minus 100 in treasury. So this whole treasury idea is that we're buying back our own stock. We're spending our own money and buying back our own stock. And the idea is that the profit or loss gets stored in that special account, paid in capital treasury stock. So retiring treasury stock, there's a couple ways to do that. You could just sell it off, or you could just wipe it out. So it's a company relating to companies buying back their own stock because they believe it's undervalued.